My name's Warren Dueck, and welcome to BizTax webinar, Repatriating U.S. Earnings to Canada. I'm joined by my colleague, Savneet Talwar. How are you, Savneet?
Good. How are you doing, Warren?
Good. What's the weather like in Calgary?
No snow yet, so that's
No
great.
snow. Okay. And it's not raining here in Vancouver. In fact, it's supposed to be pretty nice this week. Cold by Vancouver standards. It's going to be down to 2 degrees at night, which is, pretty as close as you can get it to frost almost in Vancouver.
That's normal for us, I guess. So
Yeah, well, I know that's warm. So in Calgary, hey, we're going to talk about repatriating U.S. earnings to Canada. There's two times you really need advice associated with your U.S. business. One is setting it up and getting the structure right, because foundations are important. The second time is when you want to bring money out of it, because people often make mistakes in this regard that can be easily avoided. We're going to talk about those today. And one thing I want to remind you, probably anytime you've listened to me, either on BizTax or in our Tax 101 series, I say something like this. Canada and the US have a lot of similarities. There's a lot of things we do the same, but at least in the tax world, it's the differences that count. So we're going to identify some of those. This is not a comprehensive session, but we're going to walk through those today. And, there's time for questions. There we go. We're going to do some polling questions. We're accredited. These webinars are accredited with NASBA, which I'm sure is on the tip of your tongues all the time. NASBA is the National Association of State Boards of Accountancy. So if you want to get credit in the U.S. for continuing professional education, these sessions qualify for it. You have to answer the 3 polling questions, and you have to be online for 15 minutes. The core of our session will be in that 50-minute time period. We'll have some time after it for questions. So if you do have questions, please feel free to submit them to us, and we'll either answer them online here, or we'll attempt to give you some answers offline after the session. As soon as you sign off, we're going to send you a survey that just, give us feedback. We're interested in hearing what things we're doing right, how we can be better. Those are all important. And there is a live transcript, closed captioned. You're also welcome to use that if that's helpful. On our agenda, we've identified 5 topics that all relate to paying money from the U.S. to Canada and what the tax implications are, specifically in the U.S., but also in Canada. We're going to focus on the U.S. side mostly. And those include repayment of debts. They include management fees or other payments for services rendered from the U.S. to Canada. Dividends, that's what way most people think about this subject. Liquidating distributions, and then lastly, upstream loans. So there's a little bit of everything here, and there's some variations on that subject too. Now, you can't get away from this these days. So here's the fine print. This is our disclaimer, which basically says, we're not giving you legal or tax advice. We're describing scenarios here. If you want advice, you need to consult with your professional advisor prior to acting on the information we discussed here. So these subjects are all, there's nuance, broad rules are always kind of dangerous. That we're going to alert you to some of them. How they apply is really beyond the scope of this session to do them in their totality. So thank you for joining us here. I am going to pass the first slide off on repayment of debts to Savneet. So Savneet, welcome, and it's all yours.
Thank you, Warren. So we'll start here by talking about the repayment of debts. And I think when you think about debt in the Canadian context, we usually think about, hey, it's some money that you will lend. It could be interest bearing or non-interest bearing. And I think that's the big differentiating factor here, and how US and Canada are treated, whether it's debt or it's recharacterized. So we'll talk a little bit in more detail about that. But before we do that, I think it's important to understand the US tax consequences of debt and also the interest. And then we'll talk more on the Canadian side as well. So I think when there's debt, so for example, a US company actually has to pay interest on a debt that it's got, the loan that it's received from the Canadian parent. And what is the US tax consequence of that? Is that so they do not have to pay any withholding tax on that interest. So the interesting that is a very important part here, because that means you get a deduction on the US side, and there's no withholding tax. So that's a good thing on the US side, but on the Canadian side, the Canadian rules apply, and you might have to include that as interest income. So that's the important piece. But then to qualify for the 0% withholding tax, we have to look to our US and Canadian treaty. And they actually talk about what is a qualifying interest. And that's very important to us, because if it's non-qualifying, then it is the withholding tax is actually 10%, which does not help, right? So you end up paying more tax as a withholding tax. The other piece to this is when you are paying as a US entity, you actually have to pay the US tax. So that is the important word, the payment of the interest. Sorry, you have to pay the interest. So that is the important word, because if you do not pay the interest, you just accrue it, you actually cannot deduct it on the US side, which is very, very important, because then you just have to add it back when you're calculating your US taxable income, which does not help.
So, you mentioned at the beginning here, in Canada, frequently we have interest-free loans. But when I go to the bank, they never offer me an interest-free loan. Like, they're charging me, I'm sure everybody in this audience knows that, high rates of interest. So where do I get an interest-free loan from? It's really only from related parties. Now, there's a lot of people on this webinar today listening, and if anybody in the audience wants to give me an interest-free loan, that would be great. I would love it. But I don't think you're going to do that, because you're going to say, Warren, I'm going to give you $1 million, and I'm going to charge you, 5% or 8% or whatever that rate is. But sometimes my wife actually watches these webinars just to make sure I'm actually at work. I don't know. But if she might give me an interest-free loan, I mean, there's some Canadian tax issues associated with that. But why would she give me that interest-free loan? Because
she's your wife.
Related parties.
She's your wife.
So that's the aspect that's unique in Canada. Even between related parties, the U.S. does not allow, and there's some limits on that, interest-free loans. That's a big difference between Canada and the U.S. And Canadians kind of want to use interest-free loans, but that's not so easy, actually. So
yeah, no, absolutely. And think about the interest that you're actually paying, and it's a little bit. And the other part to this is the interest limitation that you have in the US. So yes, you pay it, you're eligible for a deduction, but what determines you actually deduct it? So there is an interest limitation in the US. And in simpler terms, without diving into too much detail, it is 30% of your taxable income. So if you meet that threshold, that is when you actually get the interest deduction. And again, there are more rules regarding the gross receipts test that you have to meet. There's other stuff that you need to look at too. But all in all, like, just paying it is also not enough to get a deduction. You have to make sure you meet the interest limitation so that you can get the interest deduction in the US.
Yeah, financing is a pretty critical issue. We'll jump to the next slide here. And again, it's on repayment of debts. Now, just going back to this subject about interest-free loans, U.S. tax law requires that loans have market terms associated with them. And those include a market rate of interest, repayment terms. So, you can't have a loan that says, repay me, somewhere in the next, 300 years. It has to say, hey, you need to make a payment in, every April 15th, every August 15th, it has to specify times, dates, and amounts. There has to be collateral associated. The loan has to be really just like an arm's length loan. Now, not all arm's length loans actually require collateral, but they all will have loan documents. So you have an unwritten loan. There's really a question whether a loan really exists. You should actually formalize that. There needs to be, a debt to equity ratio that's reasonable. Again, in Canada, we capitalize our corporations by putting a dollar of share capital and then loaning the company $1 million. Would the Bank of Montreal or Royal Bank or any other lender give you $1 million if the corporation only had $1 of equity? Now, if it also had the cure for a common cold, maybe, yeah, they'd do that. That's an intangible asset. But absent some really unique scenario, lenders are not making loans to corporations that don't have what they believe for their own purposes is a reasonable amount of equity capital in the business.
So, or is it true to say it's more substance over form? So you can call it what you want, but in actuality, what it is, isn't it?
Hey, that is exactly right, Savneet. And again, that's one of those differences. Canada tax law looks a lot about the form of the transaction. In the US, the IRS can look at a transaction as, like I say, you can call it anything you want. You can have share certificate, a loan document that says it's a loan, it's a loan, it's a loan. But if the substance of the transaction, in the eyes of the IRS specifically, and also the courts in the US, say that its substance is more like equity, the IRS can recharacterize it. So if there's no market terms, the IRS may recharacterize as equity. Now, think about this. If you repay a loan from the US to Canada, the payment of principal doesn't attract any US tax, doesn't attract any Canadian tax. If you pay out equity, and we're going to go into a little more detail later, it's subject to at least a 5% withholding tax, could be rates up to 30% on that amount. And it's on the whole payment, regardless whether you call it principal or interest. In other words, all payments of principal would be subject to US withholding tax on repayment. So this can be a real problem. Now, again, we're not going to cover all the scenarios here. This is an area unto itself. The IRS were asked in 1982, I think it was, to write regulations on the characterization between equity and debt. And I think it was, correct me if I'm wrong, Savneet, I think it was in 2012 or 2015, they actually issued regulations, which were pretty much trashed by the profession anyways. And really the court rules still reign supreme here. So, this is a tricky area. You need to be conscious of it, saying that if you want to be confident you actually have something that's a debt, you need to have arm's length terms associated with it. So, Savneet, we're going to switch here. We're going to talk about management fees. Did you have anything else on repayment of debt, Savneet?
No, pretty much. I think you covered everything.
Okay. Well, we didn't cover everything, but we covered the surface. And our goal is to alert people to issues that may affect them here. So, management fees.
Sure, I'll take this one. So the management fees, when you really think about it, it's actually a fee that is paid by one entity to the other entity. And most of the time, when you think about management fee, like how do you even calculate this, right? There has to be a basis for it. So for example, a Canadian officer is doing some work for the US subsidiary. So what does that entail? So you want to pay them for their service, and I think that is very important to get the deduction. But then there has to be documentation, and without the documentation, again, a similar thing happens with recharacterization of equity. It could be considered a dividend. You're technically taking money out of the US company and giving it to the Canadian company. So if you don't have the right documentation in place, it could be recharacterized as something else, which could be even a dividend. So just looking at some of the corporate tax rates. So on management fees, if the management fees is paid from US to Canada, you would definitely get, provided you have the right documentation, you would get a deduction on the federal tax return in the US. But then also it affects the state taxes. So looking at the tax rates, the federal tax rate is 21%, and the state tax rate varies. Depends upon where you actually have activity in which state. So approximately.
So if you're in Texas or Washington, which don't have income taxes, it'd be 0. But right. If you're in California, it's about 9%.
Yeah, 8.84. Yeah. So it really depends on where you are. So essentially that 26% that you're getting could be higher as well.
Yeah, and whereas, so why are these rates important here? Like, there's a lot of numbers here. So why would you choose to pay management fees?
So I think you have to define how much of a benefit you're getting. So is it better to have your income tax in US or in Canada? So by paying a management fee, you're actually getting a deduction of, if you take this example here, it's 26%. Whereas if I was in Canada, then I would get taxed at, say, if you look at the rates that you put on there for AB and BC, so for Alberta, it's 23%. So think about it. If you didn't get this management fee deduction in the US, you would have to pay a tax on the same income of 26% instead of getting a deduction. Whereas now you're taking that money, you're giving it to the Canadian company, and the Canadian company, which is in Alberta, is actually paying 23%. So it matters, again, which state you are in or province you're in Canada as well. So, and how much benefit you get from it. Did I answer your?
Yeah. Well, I mean, this is a big deal. Now, right now, if we look at the US rate, we're saying kind of the average rate in the US is about 26%. And if we look at BC, it's say well, it's not the average rate, it's the actual rate is 27%. That's not a big difference. Like, you almost say they're almost identical. And if you were in a state that charged 6%, they'd be identical. If you're in California, it'd be higher. But the point is here, what management fees can be a tool to transfer the income to a jurisdiction that has a lower tax rate. Alberta's tax rate's 23%. If the US tax rate's 26% and you can pay 23% in Alberta, that's a win. Now, that does not make a difference, or a very significant difference. On $100,000 of income, that's $3,000. It's going the right direction, but it's not a big deal. If you talk about $1 million, now we're starting to talk about something that's going to pay for the accounting fees and stuff like that to do that. So, and if you're being taxed at the small business rate because it's services being provided in Canada, and it qualifies for the small business deduction, the rate drops down to 11%. Now, that's a really big win. Corporate tax rates, when you look at the regular rates in both Canada and the US, not the small business deduction, they're pretty close to each other right now. But it wasn't that long ago. In fact, it was just before Trump's tax reform that the US rate, federal and state combined, was 40%. That's a big difference. And there's I would say right now, particularly with the Biden administration, there's more pressure to raise US corporate tax rates than to drop them. I think Canada is probably actually more stable in that respect than the US. I'm making political comments, so you can hang me out to dry in that stuff. But, right now, I think there is more pressure in the US to raise rates than there is to drop them. Canada has learned that in order to be competitive, it has to have lower tax rates. And, you can share your comments in our questions section, though we're only answering questions, not comments. So did you have any other comments on this slide?
Yeah, so I think this is one of the common things where our clients come to us and say, hey, I'm paying so much tax in the US. And this is one of the tools that we actually use to help them lower their taxes. Of course, there's documentation involved. I think, Warren, can you talk about the documentation a little bit more? Because
Sure.
that's important.
So yeah, there's some things about, what are deductible payments to non-US persons. They need to be ordinary and necessary is a kind of a standard line in US tax law. It says, hey, they got to be related to the business. As long as they're related to the business and the US business is the prime beneficiary, they're deductible unless they're capital cost. They don't have to be, the services don't have to be rendered in the US. In fact, they don't have to be rendered in Canada either. They can be rendered in Ghana or Australia or, Iceland. So the fact that the issue here is that the services rendered to the US business are needed by that business and relate primarily to that business, essentially make it deductible. I'm simplifying things, but that's the important part of that there is that you can get that
So
deduct.
similar to interest, like the example that you gave, Warren, like why would a bank give you a loan with interest free, right? So is there similar rules for management fees as well? Like, does it have?
Yeah, there are. I mean, there has to be an arm's length component about it. Now, in other words, I can't charge you $1 million. I'd be glad to take it, by the way, but I can't charge you $1 million to, shine someone's shoes and say that was the fee. I'm glad to take it, especially when they're related parties. If somebody wants to give me $1 million, like I say, I'll take it. But if the fee should be an arm's length arrangement. But that's the interesting part here is arm's length. In things like financial transaction, there's a higher level of precision there. But when you talk about management services, it gets less precise. Like, what do we charge when we do the U.S. subsidiaries accounting in Canada, which is entirely legal? And if the brain trust for the U.S. business or people in Canada, as Savneet, you said earlier, you should be charging the U.S. subsidiary for those services rendered. If the U.S. rate is higher than the Canadian rate, you have a bias to charging them more for those services because you're pulling back income and paying less overall tax on it. So there's a big win there. There are a couple things you have to be careful of, though. One is that if you're going to have intercompany charges between related parties, you have to file, you may be required to file IRS Form 5472. And failure to file it could subject to a $25,000 penalty. The IRS is hot to trot on this issue in terms of automatically assessing it.
Yeah, I always say this. IRS loves the $10,000 penalty and the $25,000 penalty. That's the range they go for. So
yeah, and just in case anybody's uncertain, it's $25,000 US. So it's
and it's per form per related party. So
that's right. Yeah. And if the Canadian company provides services in the US, if the president of the company goes down to the US, meets with clients, is doing some work on behalf of the US company, that means the Canadian company is actually doing business in the US. And it may require a filing in the US. And that can be both with respect to employees of the Canadian business in the US and also property of the Canadian company in the US. It can even be as minor as when, for example, someone growing raspberries in Abbotsford ships them to Tacoma, Washington, because I do have some berries in my background. I picked them when I was like 10 years old. But the buyer of those berries will say, you have to ship them to us, and we'll only accept them if they're in good condition when they arrive here, not when they leave your office. So the result being is that actually constitutes doing business in the US, and that Canadian berry grower has to file or may be required to file a US tax form. It may be as simple as saying, I sold $10 billion worth of berries to the US, but I didn't have a permanent establishment there. under the terms of the Canada-US tax treaty, in which case that's all it is. It's just a disclosure. Failing to do that, as Savneet already indicated, could result in a penalty. So, Savneet, are you ready for our first polling question?
I am.
Bingo. It's all yours.
Okay, so the polling question number 1, and like Warren said, it's super important to answer all polling questions.
Do they have to answer them correctly? Like, do they get, if they don't, they get tossed out?
No, I don't think so, but we'd like to see some right answers just to make sure we are doing our jobs, right?
This is actually a test on our skills, not on our listeners' skills. Though you have to answer the question. You have to answer some. You have to give us an answer anyway. So,
right. So the question is, why might the IRS recharacterize repayments of debt to a Canadian-related party as equity? So the first choice is U.S. Treasury bills have a higher rate. The second one, debt doesn't have market terms. The third one, Canadian-related party doesn't report payment. And the last one, failure to report on IRS Form 5471. So I think we get 40 seconds to answer this question. So get all your answers in.
Yeah, now's the time to do it. And we're going to see the results right away here as we go. Boy, this is really a test on us, though, isn't it? That we communicate effectively.
So we have the answers. I think 79% said debt doesn't have market terms. I think that's right. I think, Warren, we did well. So,
and is the majority wins, or is that the right answer?
The majority wins, and it's the right answer.
Exactly. So the fact that there's treasury bills have a higher rate, that's not part of the test. The fact that the Canadian company doesn't report payment, the US doesn't care what happens in Canada. And, even if the taxpayer fails to file a tax return, that wouldn't change the result here if they filed a return. Remember, it's the substance of the deal that's relevant here. So on to the next section, dividends. So dividends. Now, the U.S. tax on dividends paid by a U.S. corporation to a Canadian corporation is 5%. This is under the tax treaty, that rate. The statutory rate in the U.S. is 30%. So if a U.S. corporation pays dividends to someone who lives in the Caymans, which doesn't have a tax treaty with the U.S., the 30% rate would apply. But for a Canadian corporation, if it owns at least 10% of the voting shares of the U.S. company, the rate is 5%. That's great. Other qualifying Canadian residents would have a 15%. Now, that's typically, we think about people, that would be businesses that own less than 10% of the voting shares, or us as individuals. If you own shares of General Motors and it pays a dividend, and you've identified yourself as a Canadian person, you would have a 15% rate. If you paid 30% on it, it's because you didn't identify yourself as being a resident of Canada. There's a special form you need to file, and you can get a refund of that difference, but you have to file a U.S. tax return to do it.
So I think it's not only just important to be the Canadian person, we actually have to look at the treaty. There are more tests that we need to meet, and we won't talk about it here in more detail, but things like base erosion test and the ownership test, it's super important to look at all those as well.
So base erosion test, that sounds like some foreign language when you say that, Savneet. So these tests are all under the limitation of benefits rules.
Right.
Right. And it basically says that the U.S. I don't think we want to go. Base erosion test is a whole webinar, but the U.S. treaties, all their updated treaties, all contain this language. There are a few exceptions out there still, I believe, but that says that it's not good enough for it to be a Canadian corporation. It needs to be majority owned by Canadians or meet certain criteria. There's about 4 or 5 different criteria it has to meet to get the treaty rate. So it can have an impact. If you're a Canadian corporation owned by non-Canadians, then you got a problem. So
exactly, yeah.
So what happens to the dividend when it's paid? You know, if you have $1,000 and you pay it from the U.S. corporation to the Canadian parent company, it would normally have a 5% withholding tax. So on $1,000, that's $50. I think my math is correct there. But if what's the tax in Canada? Well, if it's from an active business that meets the criteria as being exempt surplus, the Canadian corporation wouldn't have any Canadian corporate tax. That's a pretty good deal, actually. That's a great deal. And that means the Canadian corporation has to have at least a 10% ownership interest in the US corporation. Now, that threshold is actually under Canadian law. It's not part of the treaty, not like the one above that governs the US rate. If it doesn't meet the criteria as being exempt surplus, then Canadian corporate tax would apply. Now, we're throwing out terms to you you get to use at cocktail parties during Christmas, like base erosion and FAPI. If you say that at any of those events, you know you're going to put your listeners to sleep. But it is fascinating stuff, and so that's why I included here. Look out for FAPI, foreign accrued property income. And that's a Canadian tax term that says, how does Canada tax earnings from outside of Canada? And it particularly applies to Canadians with interest in corporations outside of Canada. For example, a US corporation. If that US corporation has investment income in it, then that income will be treated as FAPI. And there's no deferral of tax until there's a payment. That income is taxable in the year earned. Now, there's lots of rules around FAPI. I'll just warn you about two situations that might apply here. One is that FAPI can often arise with real estate, because the test for active business associated with real estate is not that you're active, it's that you have more than 5, you have at least 6 full-time employees in the business. Now, with real estate, that can often be a really high threshold, because real estate companies can literally control billions of dollars and only have a couple employees. So real estate's a danger one. The other one I just want to warn you about, if you have a US subsidiary and you have Canadian employees that have an ownership interest in the Canadian business that owns the US business, you don't want to have them receive their payroll from the US company. They shouldn't be compensated by the US company. The US company can pay the Canadian company, and it compensates that, because that can constitute FAPI income and create all these problems. Now, you've had way too much on FAPI. You know, remember that it's I know we have accountants in the audience here, so another great Christmas concept.
So Warren, we talked a lot about dividends, but are dividends and distributions the same?
Dividends and what?
Distributions?
Well, a dividend is a distribution, but there are other distributions, and I don't want to steal your thunder here, because you're going to talk about liquidating distributions. So
yes, true. So I think we wanted to step back. So if you can move on to the next slide, please.
Yeah, just before we do that, I want to say there's something good about having a US corporation owned by a Canadian corporation, because when the US profits are paid to the Canadian corporation, it becomes an eligible dividend. And that has a maximum tax rate in BC, for example, of around 37%. I'm not sure what the Alberta rate is offhand. I try not to memorize these things. But if that same US corporation paid that dividend directly to a resident of BC, for example, that dividend can be tax rates up to 53.5%. So Canadian corporations can form a really valuable role here when a Canadian has investments into the United States that are creating active business income. Remember, there's a chain of ownership there. So let's jump to the next slide here.
Okay, so this is what I was talking about, and I think it's important to know the types of distributions, right? So I think if you step back before we talk about dividends, there are 2 kinds of distribution. One is a liquidating distribution, and the other one's a non-liquidating distribution. So you basically either you give money back to the parent, when you're dissolving. And the non-liquidating distribution is you're actually giving them money, which could be a dividend, but not every distribution is a dividend. So how do you even define dividends? Dividends are actually payments that you give with respect to the shares from your current and accumulated profits. So let's think about that for a minute. So if a US entity has accumulated earnings and profits, and we'll come to the term earnings and profits because it's not the same as your taxable income. So think about it, that your current accumulated and earnings and profits, sorry, your accumulated earnings and profits are $100, and your current year earnings and profits are $50. And now you want to give a dividend of $100. So the step would be you would take $50 from your current year E&P and take $50 from your accumulated. And that would be your dividend. So your dividends are actually limited to your earnings and profits. So when I say earnings and profits, what does that mean? So it's neither your taxable income, neither your book income. So in simpler terms, it's actually your economic profit. So you're trying to determine how much money do you have in hand. So, and again, IRS doesn't really describe what earnings and profits is in the regulation, but then there are cases and laws. And from that, what we have come to know is earnings and profits is actually the cash that the entity has. And to calculate that, we would start off with your taxable income and then think about some of the adjustments we can make. So one of the most common adjustments that we make to arrive at the taxable income is the federal income tax. So for US tax purposes, we do not deduct our federal income tax. So when you start off with your taxable income, the federal income tax is already added back, but it's actually a cash payment. So to arrive at E&P, you can actually deduct it because the cash went out. So it's the money you have right now. So you take your taxable income, deduct your federal income tax. Warren, can you think of any other adjustments?
Well, I think one of the common ones is depreciation and amortization. There's tax depreciation to compute your taxable income, but it's actually different than it is for earnings and profits. And this is where this earnings and profits concept becomes a little bit hard to follow. It's not recorded anywhere, and that's part of the challenge of this issue. Now, if a company has $1 million in cash sitting in there, unless they went out and borrowed a bunch of money, the thought would be they may have earnings and profits to the extent they've actually had earnings.
Right. So, and another example would be meals and entertainment. So most of the times we do not get to deduct 100% of meals and entertainment, but it's actually cash out of your pocket. So the amount that you added back to get to your taxable income can now be deducted to arrive at earnings and profits. And then that's super important. And now going back to our example that I talked about, the 100% accumulated E&P and current year E&P is $50. But now let's change the scenario a little bit. So say our accumulated E&P is actually negative. So it's minus 100 and your current year E&P is $50. And now you have to give $100 of distribution out, right? So now you think about it, your accumulated is negative, but your current year is positive. So if you now, even though your accumulated is negative, and if you net them out, it'll still be negative, $50 is still your current year dividend. Current year E&P, which will be counted as your dividend, that the 50 because you have current year E&P. And that is important because now when you decide something is a dividend, you got to pay withholding tax on it. And now think about another scenario. You're expecting that next year you're going to have a loss. So that means the next year, this minus 100 of accumulated E&P and current year's E&P would be negative 50. So next year, your accumulated E&P and current year E&P would be negative. So you would get out of that nimble dividend that was being created just by postponing it by 1 year.
Well, there's another tax expression, nimble dividend. So you'll really impress people when you say you've got a nimble dividend. So it would make a difference whether I pay out a dividend in 2023 or 2024. One would have withholding, the other one would be a dividend in 2023 subject to withholding. The other would be a distribution, but not a dividend and no withholding in 2024.
Correct. So that's the second kind of distribution we are talking about. So once you have exhausted your current year E&P, any money you pay out is a return of capital. So what is a return of capital? So initially, when you invest money into any company, you actually give money, you actually put money into a company that becomes your basis in simpler terms. And basis is, we could have another webinar on basis itself, but it's more or less the money you invest in a company. And so and when you give money in addition to your accumulated E&P and your current year E&P, that becomes a return of capital. And then once you grind through the return of capital, it will be considered as a capital gain. So in summary, there are three kinds of non-liquidating distributions. Dividends up to your accumulated and current year E&P, then becomes the return of capital, and then the capital gain. That's the third one.
So the US requires this ordering of payments, but Canada allows you to return capital tax-free. But the US does not. And so that's another important difference between Canadian and US taxation here. The other thing I just want to highlight here is that capital gain. We have got a Canadian corporation with a US subsidiary. It pays out all its earnings and profits. That's the dividend. Then there's a return of capital. And now any amount over that return of capital is taxed as a capital gain for US tax purposes.
Mm-hmm.
Now, the Canadian company will not be subject to US tax on a capital gain arising from the shares it owns in a US subsidiary. And it's the same principle. If you own shares of Apple and you sell them and you're a resident of Canada, you won't pay US tax on them. The same principle applies here. So there wouldn't be US tax. Then the question is, how does Canada treat that? It's actually not a capital gain. It may very well be a dividend. And again, we're not going to go into the Canadian treatment of that specific question, because it's time for another polling question.
Surely is.
So polling question number 2, get on your thinking hats here. What is the Canadian corporate tax rate on dividends paid from the active business of a US corporation to a 10% plus Canadian corporation? That's a Canadian corporation that owns at least 10% of a US corporation. Is it A, 15%, B, 27% in BC, or 23% in Alberta? That's the regular corporate tax rate. Is it C, 0%, or is it D, 30%? So now where we play the Jeopardy music, where you can kind of, just be thinking about, we don't ask people to actually say how much they're going to bid on these questions, though. Maybe this might be, we have free webinars, but we have to pay money in to play the polling question.
There we go.
So our results, 45%. Now, remember, this is not majority, but 45% has said the rate was 0%. The Canadian corporate tax rate is actually answer C, 0%. It's not 15%. That might be the US tax withholding tax rate in certain circumstances. If it's from an active business of a US corporation, it's not subject to tax at all in BC or Alberta. So the 27 and 23% rates don't apply. And nor does the 30% rate apply. We didn't actually say that it met the requirements and the limitation of benefits. So if that's what you're thinking, 30% is actually the US withholding tax rate. 30% would never be the Canadian corporate tax rate here. So we better do a better job in these last ones here, Savneet. So liquidating distributions, I think this one's yours.
It is. So I think we talked about non-liquidating distributions. We talked about the dividends, the capital gains, the return of capital and the capital gain, but there are also liquidating distributions, as in when you want to close down, you want to shut shop and leave the US, and then what happens? I think the most important thing here is there's no US withholding tax when there's a liquidating distribution. Again, this could be different if you have real property, and real property rules will apply. We're not going to get into it, but That's something to consider whenever you have real property. There might be some kind of tax you're looking at. It's not always the case. And Warren, actually, can you talk about the example we were discussing?
Sure. When you talk about real property, and we've already said this a couple times here, the rules kind of change a little bit here. And some of you may be aware the US has something called the Foreign Investment Real Property Tax Act. My favorite acronym in US tax law, FIRPTA. I love it. FIRPTA. And FIRPTA applies to US real property. It also applies to US real property holding corporations. So if a US corporation, its assets are more than 50% US real property, it's a US real property holding company. Now, I was involved in a situation earlier in my career where we had, there was a lot of money sitting in the US corporation. If we paid it up, we'd pay 5% US withholding tax. It was going to be tens of millions of dollars in US withholding tax that'd be payable. And so we thought about how could we solve this problem? Well, one of the interesting things, this happened to be a company involved in the mining business. And when you think about what are the majority assets of mining companies, they're either land or more often actually leases on land, but those constitute real property. And the reserves, whether they're gold or silver or oil and gas, that's all real property until it's actually extracted. So this company, virtually all its assets constitute US real property. And because of that, because it's a US real property company, we could liquidate the US company and avoid the application of FIRPTA and bring home and avoid literally tens of millions of dollars withholding tax. So you got to actually kind of think about what you've got here, and liquidating distributions are a great planning tool. Now, they have their own set of problems, and you have some other notes here too, Savneet, so I'll let you speak to those.
Oh, absolutely. I think one of the other important things is it doesn't have to be a single transaction. So if you adopt a complete plan, you could have series of transactions which could be, and those could be considered a liquidating distribution. And it's super important to actually have a plan so that it's not considered dividend initially. So and then it's considered as a liquidating distribution, and it doesn't have to be all in 1 year as well. It can be spread over more than 1 year, as long as you have a complete plan of liquidation. So Warren, how's the tax? How's this liquidating distribution taxed in Canada?
Well, I mean, it really depends on the underlying facts there. And Canada's going to look back at that exempt surplus rule saying if you're distributing earnings from the US, then they may not be taxable. And when we're talking about active businesses, and remember, I put an asterisk by that, when you're talking about real estate or investment businesses, or when you have an owner in Canada working for the US company, the rules change. But in many cases, you can distribute that distribution. Some or all of it may be exempt surplus and not taxable in the Canadian corporation. Plus, when it's paid out to the shareholder, it may be treated as an eligible dividend when it's paid out by the Canadian corporation. It can't be paid directly from the US corporation to the Canadian shareholder, but from the US corporation, Canadian shareholder.
Awesome. So now I think we've talked about loans, we've talked about dividends, we've talked about liquidating distributions. And so I think, Warren, can you walk us through the upstream loans as well?
Sure, I better, because I said I would, right? Yeah, upstream loans, these are problems for both Canadian and US tax purposes. And when there's a loan by a US subsidiary to a Canadian shareholder, you should think this is potentially a problem. Everybody likes this kind of rule. They say, well, we got a bunch of money in the US company, let's pay it up to the Canadian shareholder and let them hold it. We don't want to pay tax, we don't pay withholding tax on it, so we'll call it a loan. But these loans may be recharacterized as dividends. And if they are, they'd be subject to a US withholding tax. And plus, you'd have penalties and interest for failing to remit the tax to the IRS. So upstream loans are dangerous. And if you have a short-term loan for a specific purpose, you may be safe. So what's a short-term loan for a specific purpose? A short-term loan generally is viewed as a year or less, and a specific purpose saying, hey, you're going to do an acquisition in 2025, but the Canadian company needs this cash for some limited period of time, and as soon as that period ends, we're saying a year, it's immediately paid down. All the other terms are market terms associated, but be careful about upstream loans. If there's no earnings and profits, we talked, Savneet talked about that, then even if it was recharacterized, it'd have no impact. It'd be then a return of capital and then a capital gain. We already said the capital gain wouldn't be taxable in the US. So you'd have to look to see what are the Canadian tax consequences associated with that. So did you want to add anything there, Savneet?
No, I was looking at the time and I think it's time for polling question number 3.
Well, you can't get away from polling question number 3. This is your graduating diploma here, everybody. So polling question number 3 is, what is the US tax rate payable on liquidation of a US corporation paid to a Canadian shareholder? Is it 5%, 15%, 30%, 0%, or none of the above? So this is where the music plays again here. So
yeah.
You need this. You need to answer this question right or wrong to get credit for it for continuing professional education in the U.S.
I think our overriding theme of the session has been substance over form. Like we talked about interest, we talked about dividend, we talked about loans. It's essentially what's the actual substance in it, and not the form or what you call it for the US side.
Yeah. Those are important concepts here. Do we have an answer? Oh, there it is. And 0%, 50%. So we're going up. It was 45% last time, but 50% said D, 0%, which is the correct answer. It's not 5%, it's not 15%, it's not 30%, and it's not none of the above. It's 0%. So that ends our presentation, but we do have time for questions. And I know we've got some questions there. And Shan, I think you're going to read us some of those questions, and you can let us know if you think it's maybe who the question's directed to, and Savneet and I will answer them the best we can the time that's available. If you're not able to stay, you're not required to stay for the questions. There's no more polling questions, so you're off the hook there. But thank you very much for joining us. Please complete the survey, and we appreciate your input. And we'll answer the questions. We'll maybe see how far we get on them. And thank you again. Shan, what do you got for us?
Oh, thank you, Warren, for the presentation. That's so neat. So the first question is on the interest that on the loans we talked about. So the Canadian parent gave the US entity a deposit to handle the working capital, and that is interest-free. And the client also have a similar type of transaction to a US vendor that giving deposit to them and will holding the accounts build up, so they don't charge interest on it. So is there an argument that the third party entity having the same treatment as the related party entity, so the loan can be at 0% and no withholding tax for all repayment?
You mean, is that with respect to the loan to the vendor or on the working capital? Or both?
On the working, well, probably both, but mainly concerning on the working capital.
Did you want to take this one, Savneet, or you want me to do that?
So let me try, and then you can add and probably Warren.
Sure.
So I think it matters the terms, right? So I've had a client who basically gave out some money to a third party as a deposit, right? But then it had to turn in a certain period of time. Like there were always terms and conditions related to it. So again, we're looking at the form, substance over form. So if it is turning and you're saying you're keeping it for a little bit of time and then you know what's going to happen after that, then I think that's what would happen, right? Then it's okay, it's not really a loan. But then if it's not a deposit and you have it documented and nothing happens with that money, it keeps sitting over there, right? Then that could change the scenario. So I think the answer depends upon what the agreement is, what's happening with that money. Warren, would you like to add something?
Yeah, I'll be a little more definite here. The working capital loan, if it's revolving, every 30 to 60 days, in other words, it's going up and down because there's inventory being sold and, money gets paid back right away and stuff like that. That's fine. But if it's not revolving and it's, fixed, it's, $100,000, $1 million, whatever that number is, and it's outstanding for periods of more than 60 to 90 days, to get it treated as a loan and not equity capital, it should go through all those market tests. And one of those is market rate of interest associated with it, because that means the repayment is at risk. Now, we always talk about this subject. I was sharing with Savneet. I started my professional career in another century. You might gather that, or I may have thought that already. But in my whole career, well, I've read about this subject constantly, and there are court cases that come up. So that's not like it doesn't exist. I have never personally ever had loans recharacterized as equity. Now, there's a whole bunch of reasons there, and one of them is just the fact that they haven't been subject to examination. And I'm not saying that my clients have been subject to examination, but the ones that have non-interest-bearing loans are. The Canadian company does not have to charge an interest rate under Canadian law. Under US law, they're not required to do that under the below-market loans scenario. There's an exception there for foreign lenders. But under the US's transfer pricing rules under Code Section 42, I said I wouldn't mention Code Section tonight. So I mean, I did it. But under transfer pricing rules, those may be applied to saying, no, there should be an interest rate fixed here, and it can be treated as equity, recharacterized as equity. So that's the risk there. So that's what, if you got a loan outstanding for more than 90 days, typically you're going to have a problem here. If it's revolving, that's not a problem. With respect to the vendor, if a Canadian corporation or a non-US corporation makes a deposit, they are not required to charge interest on that. And there is no interest there. Now, again, it's going to come down to facts and circumstances. Savneet mentioned about substance over form. Like, what's really happening here? Is this a deposit because you're giving $1 million to buy some equipment and machinery that they have to manufacture over the next year? And it's a deposit for that? Or are you really financing their business? And so there's the facts would have to be clear here to be more precise. But with the working capital over long term, yeah, you got a problem there. There's an interest charge, or you're at risk of being recharacterized as interest. And that would mean the repayments of that loan, I'm using air quotations there, may be recharacterized as equity and taxed as a dividend in the US. We got other questions, Shan?
Yes, thank you, Warren and Savneet, on the elaboration of that question. The second question is, how is contingent interest defined?
The contingent interest is an interesting, which frankly, you don't see very much. Contingent interest typically exists where, for example, a lender comes in and says, I'm going to give you $1 million for this project or this business activity. And if you do really well, you not only pay me the 10%, you give me something on top of that. And You know, in other words, if you make $10 million, I get 3% of the $10 million. So it's contingent on reaching certain criteria. That's the most frequent use I see it. Not very common. It's there. Most interest to be qualifying interest. It's fairly unusual to see contingent interest, but it does happen.
Okay. Thank you. Would we have time to have a last question?
One more question, sure.
Okay. So if most of the services provided by Canco to earn management fee are performed in Canada, but employees periodically travel to the US location, does that create a US filing requirements for Canco? Or would this only be the case if Canco has a PE in US?
What's a PE?
Firm is an establishment.
Yeah, so that's a treaty test. Yeah, that permanent establishment is a defined term. Savneet, do you want to take a shot at this?
Sure. I think first of all, you look at the sourcing rules, right? So under the sourcing rules, the management fees is sourced to where the services are performed. So they're actually sourced to Canada. So technically, it doesn't really create any US sourcing income. However,
but Savneet, they said some of them were actually, some of the services were performed in the US.
This I thought the question was they went down to the US not so frequently. Is that
But
right?
they went to the US.
Right, right. So some of it was performed were in the US, but I think there are rules around how much time you can spend in the US regarding. So there's a services PE rules, like you have to look at how much time they're spending, and I think if it's under the 183 days, then it's okay. But it should not be significant. It should not be regular. You should be performing ancillary activities. And one of the few things that we tell people is don't go down there and start signing contracts. That would definitely get you in. It's not the only rule, but one of the major rules just to avoid permanent establishment.
So the permanent establishment, I'll just step in here. Whether or not you have a permanent establishment, if there's services performed in the US, whether they're all the services are performed in all the services are from the Canadian corporation, they're billed in Canadian dollars from the Canadian business, but personnel travel to the US and provide some of those services. Some of those services are US source. Now, we didn't say whether they'd be taxable. That's the permanent establishment question. But those services performed in the US are US source services. So there's a business being conducted in the US. And if a business is being conducted in the US, then there's a filing obligation federally, either a filing obligation to say, hey, we're taxable on those services. That would only occur where there's a permanent establishment. But if there's services performed in the US, but there's no permanent establishment, and a permanent establishment, I'm just going to make it real simple, are things like having an office in the US or habitually exercising the authority to sign contracts. And those things create a permanent establishment. That's a subject we'll actually devote a whole seminar on, but you know, a permanent establishment is something more than just traveling down typically and seeing something on occasion. That's really not where the problem is. But in most cases, Canadian businesses that don't have a permanent establishment, all they'll be required to do is what's called a treaty disclosure return that says, you know, we did $20,000 of services in the US and we don't have a permanent establishment, there's no US tax.
And they love the $10,000, right? So if you don't file that treaty form, there's a $10,000 penalty just to add to that. So
yeah, there's penalties everywhere in the US, that's for sure. I'll just raise one other point here too, is that when the Canadian employee travels down to, you know, Oregon or South Carolina or New York, those states all impose income taxes. Not all states do. But when they impose an income tax and the services are provided in that state, the federal rules and the treaty do not apply to state income tax. So you might not have any federal tax, you might have a state tax associated with that. And in states that don't have income taxes, remember, they have highways and freeways and schools and things like that too. They have other taxes. So you may be subject to those other taxes. Now, this is kind of a practical sort of thing you have to look at. You can create a paper blizzard. We have had clients that literally file in all 50 states. But you need to be practical here too, and saying, hey, we spent half a day in Oregon, or but otherwise we spent all our time in California. You probably have you may have an obligation to file in Oregon, but look after the big questions first. If all your services or most of your services are being rendered in California, that's the one where I'd focus on. And management fees are interesting issues, especially when you have services performed in the US. That's our last question, but thank you so much again for joining us. Please fill out the webinar, or the survey when you're done, and we look forward to seeing you again on BizTax, and thanks for joining us. Thanks, Savneet.
Thank you.